To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
So Peter, Paul, and Prince were partners sharing profit and losses in the ratio of 2:1:1. Okay. So it was provided. Guys, please mute yourself. It was provided in the partnership deed that in the event of retirement death of a partner, he or his legal representatives would be paid the following: balance in the capital account. Okay, even if they don't mention this, we know that it has to be given. His share of goodwill in the firm, valued at 2 years purchase of normal average profits after charging interest on fixed capital. So we'll have to calculate the normal average profits after charging interest on capital, and that average has to be done for 3 years to 31st December preceding the retirement or death. So say for example, if the partner dies in the current year 2022, you have to consider till 31st December of 2021. Okay. His share of profits from the beginning of the accounting year to the date of retirement or death, which shall be taken on proportionate basis of profits of the previous year, has increased by 25%. Now, a simple statement: whatever is the previous year's profit, you will increase that by 25%, and proportionate share, and also on the basis of time, you will consider the share in profit. Interest on fixed capital of 10% per annum payable to the partners will not be payable in the year of death or retirement. Again, in this part, you will not give interest. You will not give interest in the year of death. All the assets are to be revalued on the date of retirement or death, and the profit and loss to be debited or credited to the capital accounts in PSR. So this is also an extra information. Anyways, this is known. Now, Peter died on 30th September. So one good thing for exams is everybody dies or retires on the first day of the month or the last day of the month. So no complications in number of days. Books of accounts are closed on calendar year basis. So financial year is from 1st of January to 31st of December. Balance in the fixed capital accounts as on 1st January where Peter 10,000, Paul 5,000, and Prince 5,000. Okay, so these are the fixed capitals. Balance in current account 20,000, 10, and 7. What will we do with the current account?
After adjustment, we transfer it to capital accounts.
Yes, after adjustments, we'll transfer that to capital account. Okay. Then drawing of Peter till 30th of September were 10,000. What will we do with this? Drawings of Peter?
Sir, if interest was to be provided, we'll.
So the question has not mentioned anything about interest, so we'll not provide any interest. Okay. Then in that case, what will we do with these drawings?
So we'll reduce it from capital.
Yeah, so we'll debit it to the current account and or transfer it to the capital account. The profit of the firm before charging interest on capital for calendar year 16, 17, and 18 were 1 lakh, 1 lakh 20, and 1 lakh 50 respectively. So that is the amount of profit before charging interest on capital. Okay. The profits include the following abnormal items of credit. So profit on sale of assets 5,000, insurance claim received 3,000, 7,000, 10, and 12. Now, whenever we are valuing goodwill, we will value goodwill using the normal profits and not the abnormal profits. So we'll make adjustments for this. Then the firm has taken a joint life policy of 1 lakh. Besides, the partners had severally insured their lives for 50,000 each. Now, when we say that the partners have severally insured their lives for 50,000 each, means on each partner's life, there is an insurance of 50,000 and there is an overall joint life policy of 1 lakh. Then the premium was charged to P&L. Now, if premium is charged to P&L, and here we said Peter died on 30th of September, how much amount will we receive from joint life policy?
So the total amount to be received would be for the joint life policy account, the total policy value, so 1 lakh.
1 lakh will be received. Very good. Then what about the separate life policy?
Sir, for the partners who have died, the policy value will be received, and the existing partners, the surrender value will be received.
Very good. So for one partner who has died, we will receive 50,000, and then it says Surrender value of policy were 30% of the face value. So for remaining to 30% of 50,000, that is 15,000 each. Okay, right? Then on June 30th, 2019, the firm received notice from the insurance company that the insurance premium in respect of fire policy had been undercharged to the extent of 6,000 in the year of 2018, and the firm has to pay immediately. Now, where all will this have an impact when we come to this settlement? The question says in 2018 we had to pay 6,000, which we did not pay. Correct?
Evaluation.
Now, what will be the impact of this?
So the profits of 2018 has to be reduced to this extent of 6,000.
Profits of 2018 has to be reduced to the extent of 6,000. Okay, then
So that the effect should be given to the capital accounts of all the partners.
why should we give the effect to the capital account of the partners?
Revaluation account, there'll be a
So because there is an unrecorded liability. So this adjustment has two impacts. One, you will have to adjust it while calculating goodwill. And second, because there is an unrecorded liability, or we have to pay a fresh, some amount to the insurance company, this 6,000 represents a revaluation loss. Correct? Yes or no?
Yes, sir.
Okay. Then the revaluation of the asset indicate an upward revision in the value of asset to the extent of 20,000. Prepare an account showing the amount due to Peter's legal representatives as of 30th September. Okay. So other than a lot of calculations, and because it is given in a text format, this question is not very complicated. As we take up each adjustment, we'll be able to understand that. And anything specific here, you have said assets to be revalued on the date of retirement and profit and loss to be debited and credited to the capital accounts in the profit sharing ratio. So here we'll credit it to capital accounts, will not credit it to current accounts. Okay, you can credit it to current accounts if this was not there, but otherwise you'll have to do that. Now here, if you have to prepare the amount due to the firm, here if you have to prepare the amount due to the partner, not to the firm, we need goodwill. We need to do revaluation. Okay, then we need to prepare the partner's capital account, current account, joint life policy. Right? These are the things. Yes or no?
Sir, what is joint life policy?
Sorry?
What is joint life policy?
Joint life policy is a policy taken on the lives of the partner. If you have missed our previous session, we had covered or a session prior to that, maybe we had covered joint life policy in detail. Okay, so
Okay, sir.
here first thing we'll prepare is the goodwill part, calculation of goodwill. Now what does the question say? The question says take profit before interest, charge interest on fixed capital, and we have to do adjustments for abnormal item, and there was one item of insurance which was not considered, that we have to consider. So he died in 19, so 2017, 2018 and 2019 profit as per P&L before interest. What is the profit as per P&L before interest? Let's come back and see. Yeah, it says 1 lakh, 120 and 150. So 1 lakh, 120, 150. Okay, then less interest on capital at 10%. Correct? 10% is what they said. Fixed capital is 10%. So Peter, Paul and Prince, 10,000 plus 5, 15 plus 5, 20,000 if you do. How much is the interest at 10%? 2,000. Correct? 2,000, 2,000, 2,000. Then there are some adjustments to be done. Now, tell me one thing. When we have profit and sale of asset which has been credited to P&L, while calculating goodwill, what will be the adjustment be? Will we add or will we deduct?
Deduct.
Why will we deduct it?
So because the value of asset, the money received has been added to the P&L account, sir.
Correct. So because it has been added, now we will reduce it. If it was reduced, we will add it. Okay. So because it was added, now we will reduce. And see, the reason why I'm asking this simple question again and again is so that it is reinforced in the examination. The moment you see this adjustment, it should come to your mind that yes, we have to reduce it. So 5, 7 and 10, 3, 0 and 12. Minus 5,000, minus 7,000, minus 10,000. And then we have 3, 0 and 12. Correct. Then there was an expense which was not charged. Now we have to charge it. And which year was that? That was in the year 2018. So, sorry, this is 2016. This is 2016, this is 2017, and this is 2018. And here there is an insurance expense not charged. That is 6,000. Okay. With this, we'll get the adjusted profit. N minus 10, 90,000. 111 and 1,20,000. Any doubt so far?
No, sir.
No doubt. Okay, thanks. Then average. Now see here, you can do a weighted average. Did the question tell anything? The question mentioned what? How do we do the goodwill here? 2-year purchase of normal average profit. So we'll just take a simple average profit. Average profits is equal to sum of these three divided by 3. You get 1,07,000. Okay. Now years of purchase 2. Goodwill 1,07,000 multiplied by 2, which is 2,14,000. How much is Peter's share? 2,14,000 multiplied by, what is the ratio? 2:1:1. So 2 by 4, which is 1,07,000. Now, friends, in this question, the question has only asked us to prepare Peter's account, their related account to Peter. So need not worry about what is the share of the remaining two partners. Okay. So this calculation or this much of calculation is more than sufficient, right? Then once we are done with the goodwill calculation, we can start preparing the partners account. So let us do that. Peter's capital account and Peter's current account. So here capital account of Peter is 10,000 and current account of Peter is 20,000. So by balance 10,000, by balance 20,000, right? Then is there any other balance given here which has to be transferred? Nothing has been mentioned here. So we will go one by one. We have to give the treatment of goodwill. Goodwill Peter's shares is 1,07,000. So by what are the two partners? Paul and Prince. By Paul and Prince, it is 1,07,000. This number. Okay, you can distribute between Paul and Prince in their existing ratio. That also you can pass the entry, not a problem. So goodwill credit has been given. Interest, will we provide interest on capital for this year?
No, sir, because the question said it's not payable on the year of death.
The question said because it is not payable on year of retirement, we will not be providing any interest. Correct? So that interest will not be provided. We need to provide share of profit. Now, how do we calculate share of profit? we have to take previous year's profit, correct that for the insurance amount, and on that increases 25%. So profit for 2018 was how much? 1,50,000 less insurance expense 6,000. So correct profit 150 minus 6, 144. Add 25%. So this multiplied by 25%, 36. So the total comes to 1,80,000. So estimated profit. And when did he die? He died in September. So how many months of profit is he entitled to?
9 months.
How many months of profit is he entitled to? 9 months, right? Because January to December is the calendar year. So he is entitled to a profit share of 9 months. So profits for 9 months is 180 divided by 12 multiplied by 9. You get 135. Here is half. So, guys, please mute yourself. Share is half, so 67,500. But this profit is before interest. I think we excluded interest. No, interest was also given in the previous period. So we'll have to provide for interest. See, we will not provide for interest on Peter's capital, but for other two partners, will we provide interest or not?
Yes, sir.
So less interest on capital for remaining partners. So for all the partners, it was 2,000. For the remaining two partners, it will be 1,000 because their capital is half. The capital is 5,000 and 5,000. So interest will be 1,000 for the full year. So adjusted profit will be 180 minus 1,000. That is 179. Profit for 9 months is 179 divided by 12 multiplied by 9. And his share is half, which is 67,125. Now this share of profit will be credited to current account. 67,125. Then,
Sir,
yes,
sir, why are we not the 25%? No, sir, we are making it 125%. So that why don't we do after?
sorry, sir, can you be a
giving
bit
interest?
louder? Can you be a bit louder?
Sir, we are after adjusting the profit, we are taking 25% increase, and then we are reducing interest on capital now, sir.
Correct.
But
Correct.
sir, but shouldn't we first also adjust for the interest on capital and then increase by 25%, sir?
The profit is profit from the business. Okay. Interest is fixed. Interest amount is not changing. Last year also you paid the same rate of interest. This year also you are paying the same rate of interest. Your profit, what we are talking about, is profit from your normal operations from the business. Interest is an item of P&L appropriation.
Yes, sir. Yes.
Okay. So if you
Yes.
see the question, what does the question say? Proportionate basis of profits of the previous year. So we are talking about what is the profit that the business has earned. Based on that, what will be the increase in 25%? And of course, we have to pay interest to the other partners. On that basis, we have taken proportionate profits for 9 months. Okay.
Yes, sir.
Right. So this is done. Profit is done. Then revaluation. Then revaluation. Revaluation, it says assets to be revalued and the profit and loss to be debited or credited to the capital accounts. Now, revaluation profit is 20,000 here. So, in his capital account, you have by revaluation, half of that will be 10,000. Then there is an unrecorded expense which you would be taking to your revaluation account, that will be debited. So to revaluation, or you can say to cash or bank, either ways is fine. Amount was 6,000, of that half is payable. So of that half is pertaining to Peter, so 3,000 will be debited there. Okay. Now, after this, we are left with one more important adjustment, that is joint life policy. Now, joint life policy, sum assured is 1 lakh. Amount received will be 1 lakh. And again, this will be a good revision for those of you who had not, who had forgotten, or, who had not revised enough in the previous class. Do we have any joint life policy as asset in the balance sheet?
No, sir.
Do we have any joint life policy as asset in the balance sheet?
No, sir.
We don't have, which means entire 1 lakh is a gain which has to be credited to partner's account. So Peter's share is 1 lakh divided by 2, 50,000 from here. Then separate policy, Peter and other two partners, I don't remember the name, Paul and Prince maybe. Sum assured 50,000. Here you will receive entire 50,000. Here you will receive only 50%. No, sorry, 30%.
30%.
And here also you will receive 30%. Peter's share will be this divided by 2, divided by 2, divided by 2. The total of this is 90,000. So insurance premium or insurance claim by insurance proceeds 90,000. Then I think they are given drawings also, if I recall it right. Drawings of Peter were 10,000. So 2 drawings 10,000. Okay. Now whatever is the balance will be transferred to the capital account. So to capital account. Now you can do the total here. Minus 10 minus 3. So 271125 is transferred to capital account. Let us see if we did it rightly or not. Two 271125. So this is done correctly. Okay. So this will be transferred to capital, or you can directly transfer to executors. And even here, 10 and 10, 20 transfer to executor's account. Right. Then you have to prepare the executor's account. They have not prepared. Executor's account from capital, from current to balance carried on. Simple question. Any doubt here? No. Okay. Hope it's clear.